Okay, let us get straight to the point. Silver right now, on the 3rd of January 2026, is trading around $73 per ounce. 1 year ago, it was $30, a rise of 150% in 1 year. This is the best result since 1979, 47 years ago. In December 2025, silver broke through $86, an absolute all-time historical high. Then it pulled back to 72 to 74, where we are now. People locked in profits at the end of the year. This is normal. The question is, what comes next? $100 is only 35% growth from current levels. After the metal rose 150% in 1 year, another 35% sounds quite realistic. Or is this greed and hype? Let us examine how we even got to $74. The first driver is critical mineral status in the United States. The Trump administration, in 2025, officially declared silver a strategic metal. This is not just words. This includes protective tariffs on imports, subsidies for domestic mining, and strategic reserves. When the government says this metal is critical for national security, the market hears shortage is inevitable, price will go up. The second driver is physical shortage. According to data from the Silver Institute, the deficit amounted to more than 200 million ounces in 2025. This means demand exceeded production by 20% of total annual mining output. Where was the difference covered from? From inventories. Stockpiles on the COMEX commodity exchange fell to critical levels. Eligible silver, metal available for delivery, is at the lowest levels in 15 years. The third driver is solar panels. This is the fastest growing source of demand. In 2025, 20% of all produced silver went into solar panels. Each panel contains approximately 20 grams of silver. The renewable energy boom is only beginning. Governments around the world subsidize the transition to green energy. The United States, Europe, China, India, all are building solar farms like crazy. The forecast is that by 2030, 30 to 35% of all silver will go into solar. This means an additional 300 to 400 million ounces of demand per year. Where will they come from? It is unclear. The fourth driver is electric vehicles. Each electric vehicle contains 25 to 50 grams of silver, 2 times more than a conventional internal combustion engine car. In 2025, around 30 million electric vehicles were sold worldwide. This is 750 to 1,500 tons of silver used only for electric vehicles. By 2030, the forecast for sales is 100 million electric vehicles per year. Multiply by an average of 40 grams, and you get 4,000 tons of silver, or 130 million ounces of additional demand. The fifth driver is institutional demand. Previously, silver was a retail game. Ordinary people bought coins and bars. Institutions ignored it. The market was too small and lacked liquidity. In 2025, this changed. Hedge funds, pension funds, and sovereign wealth funds began entering silver. Exchange-traded fund inflows are at record levels. Physical metal is being bought by the ton. Why? 2 factors. The first is protection against inflation. The Federal Reserve talks about rate cuts in 2026. Lower rates historically equal growth in precious metals. The second is geopolitics. Ukraine has been at war for the 3rd year. The Middle East is unstable. China threatens Taiwan. The United States imposes sanctions on Venezuela. The global tension is rising. In such an environment, investors want safe haven assets. Gold rose by 66% in 2025. Silver rose by 150%. Silver proved itself as a better hedge than gold. The 6th driver is the gold to silver ratio. This is how many ounces of silver are needed to buy 1 ounce of gold. 1 year ago, the ratio was 90 to 1. Gold cost $2,600, silver $30. Now the ratio is around 59 to 1. Gold is $4,400, silver $74. The ratio compressed by 35% in 1 year. The historical average over 100 years is 60 to 1. We are exactly at the historical average. This means silver is no longer undervalued relative to gold. Further growth in silver must move together with gold, not ahead of it. But in moments of maximum industrial demand and speculative frenzy, the ratio fell to 30 to 1 and even 15 to 1. In 1980, the Hunt brothers pushed it to 15 to 1. In 2011, it was 32 to 1. If the ratio falls to 40 to 1 at the current gold price of $4,400, silver will cost $110. There is your $100. The 7th driver is that supply cannot grow quickly. 70% of silver is mined as a byproduct of copper, lead, and zinc. Companies mine these metals. Silver comes as a bonus. The price of silver almost does not affect production volume. Even if silver is $200, copper mines will not mine more just for silver. Copper production determines how much silver comes out. New primary silver mines take 7 to 10 years at minimum from exploration to production. That means the deficit we have now will not be closed quickly, even if the price is $100. These are the 7 drivers that brought us to $74. Now the question is, are they enough to reach $100? Let us build a scenario of how silver reaches $100 and higher in 2026. The first catalyst is the Federal Reserve cutting rates. The Federal Open Market Committee minutes, published at the end of December, showed that committee members are open to rate cuts if inflation continues to fall. The current rate is 4.25 to 4.5%. Inflation is 2.9%, almost at the target of 2%. The labor market is cooling. Unemployment is 4.1%. All conditions for cuts are in place. The forecast is 2 to 3 rate cuts of 0.25% during 2026. The rate will fall to 3.5 to 3.75% by the end of the year. What does this mean for silver? Historically, there is an inverse correlation. When rates fall, the opportunity cost of holding non-interest-bearing assets, such as gold and silver, decreases. Money flows from bonds into precious metals. In 2019 to 2020, the Federal Reserve cut rates from 2.5% to 0%. Silver rose from $14 to $29. It doubled. In 2010 to 2011, during low rates, silver reached $49. If the pattern repeats, silver can easily reach $100 to $120 at rates of 3.5%. The second catalyst is a weaker dollar. The Wall Street Journal Dollar Index fell by 6% in 2025, the worst result since 2017. Why is the dollar falling? The fiscal deficit of the United States is $2 trillion per year. Debt is $36 trillion. The world is losing trust. Central banks around the world are diversifying away from dollars into gold, yuan, and euros. De-dollarization is a slow process, but it is real. China and Russia settle oil payments in yuan. The Saudis are discussing selling oil for yuan. The BRICS countries are creating an alternative currency. When the dollar falls, commodities denominated in dollars rise. This is a mechanical effect. If the dollar falls another 10% in 2026, silver will rise 10% just to preserve purchasing power. $74 plus 10% from dollar weakness equals $81, plus additional fundamental drivers. The third catalyst is a physical squeeze. The Reddit group. Wall Street Silver has more than 400,000 participants. They buy physical metal and hold it. In 2021, they tried a short squeeze on COMEX but did not have enough money. Now the situation is different. The price is already $74. Momentum is huge. Institutions are involved. If retail adds another impulse of mass buying, available supply may run out. Dealers are already charging a premium of $8 to $12 above the spot price. 1 year ago, it was $3 to $5. This is a sign of physical metal shortage. People are willing to overpay because the metal is hard to obtain. COMEX eligible stocks, metal available for delivery, are around 300 million ounces. If institutions begin demanding physical delivery instead of cash settlement, the exchange may not cope. In such a scenario, the price rises vertically, $100, $120, $150 in weeks. This is not a forecast. This is a risk scenario, but the probability is not zero. The fourth catalyst is supply disruption. Mexico produces 23% of the world's silver, the largest producer. The policy of the left-wing government is unpredictable. There are discussions about nationalization of mines. If Mexico nationalizes or introduces export restrictions, more than 200 million ounces of silver drop out of global supply. The deficit worsens. Peru is the second largest producer. There are constant protests against mining companies, road blockades, strikes. In 2023 to 2024, several large mines were idle for months. Any major supply shock pushes the price up sharply and quickly. The fifth catalyst is a technical breakout. Silver finally broke $50, the psychological barrier that held for 14 years since 2011. In December, it reached $86. Technically, the path is clear. The next resistance levels are $100 and $120, then nothing until the old highs of $180, the 1980 price adjusted for inflation. Momentum traders, algorithms, trend followers, all will buy on breakouts of levels. This creates a self-fulfilling prophecy. Break $80, everyone buys, we fly to 100. Break 100, we fly to 120. The sixth catalyst is an unexpected source of demand. Artificial intelligence data centers. Each server contains silver in contacts, solder, and cooling systems. Microsoft, Google, Meta, and Amazon are building massive data centers for artificial intelligence. Investments are in the trillions of dollars. NVIDIA sells graphics processing units in millions of units. All of them contain silver. Exact consumption figures are not published, but experts estimate 50 to 100 million ounces of additional demand from artificial intelligence, built out by 2028. The seventh catalyst is speculative mania, the most unpredictable but the most powerful. In 1980, silver reached $50, not because of fundamentals, but because the Hunt brothers inflated speculation. In 2011, it reached $49 on a wave of quantitative easing and fear of inflation. Fundamentals were not as strong as now, but sentiment was bullish. If fear of missing out captures the market, if everyone starts buying because the price is rising, because neighbors are making money, the price can fly anywhere. $100 in such a scenario is not a ceiling. $150, $200 are possible in months. Adding up the catalysts, the Federal Reserve cuts rates, adds $10 to $15. The dollar weakens, adds $8 to $10. The deficit deepens, adds $10 to $15. Technical momentum adds $5 to $10. Speculation adds $10 to $20. $74 plus a minimum of $43 and a maximum of $75 equals a range of $117 to $149. $100 is not just realistic. It is a conservative target if at least half of the catalysts work. Okay, and now why $100 may not happen. Because you cannot look only at one side. The first risk is that silver is already too expensive, a rise of 150% in 1 year. The relative strength index is in overbought territory. The moving average convergence divergence shows divergence. All technical indicators are screaming overbought. Sentiment indicators are extremely bullish. When everyone believes that an asset will rise, it usually falls. Contrarian logic. After such a rise, a normal correction is 30 to 40%. From $74, this is a pullback to $45 to $52. Before going to 100, the market may first correct and shake out weak hands. The second risk is that a recession will kill industrial demand. 60% of silver goes into industry, electronics, solar panels, medicine, electric vehicles. This is not investment demand. This is real consumption. If the economy of the United States or China enters a recession, production will slow and demand for silver will fall. Solar panel production will decline. Electric vehicle sales will fall. Electronics will stagnate. In the recession of 2008 to 2009, silver fell from $20 to $9, minus 55%. Industrial demand collapsed faster than investment demand grew. Forecasts for 2026 put the probability of a recession at 30 to 40%, according to analysts. If it happens, silver will not reach $100. It will more likely fall to $50 to $60. The third risk is that the Federal Reserve does not cut rates. If inflation accelerates again, Trump's tariffs are inflationary and the budget deficit is inflationary, the Federal Reserve may keep rates high or even raise them. Higher for longer means a strong dollar, outflows from commodities, and downward pressure on silver. In a scenario where rates remain at 4.5% or rise toward 5%, silver may pull back to $60 to $65. $100 is impossible in that case. The fourth risk is technological substitution. Solar panel manufacturers are working to reduce the use of silver, copper pastes, and alternative materials. If a breakthrough happens, thrifting may reduce silver consumption in solar by 30 to 50%. This removes 60 to 100 million ounces of demand. The deficit turns into a surplus. The timeline is unclear, maybe 2027, maybe 2030. But the risk exists. The fifth risk is that above-ground inventories are larger than they seem. Official statistics show 2 billion ounces of inventories. But how much silver sits in private hands and jewelry and old electronics? If the price is $100 and higher, mass recycling will begin. People will melt grandmother's silver and turn in old electronics. Supply will increase. In 1980, at a price of $50, people stood in lines to sell family silver. The same may repeat at $100. The sixth risk is that regulators change the rules. In 1980, COMEX raised margin requirements 5 times in 2 weeks. This collapsed the price from $50 to $10 within months. If silver flies toward $100 too quickly, the Commodity Futures Trading Commission may intervene, limit positions, raise margins, ban speculation. The stated goal will be to prevent market manipulation and protect retail investors. The result will be a price crash. The seventh risk is profit-taking. People who bought at $20 to $30 in 2024 are sitting on profits of 150 to 250%. At $100, this will be 300 to 400%. The temptation to lock in such profits is enormous. Mass selling will create downward pressure. Institutions also take profits. Hedge funds do not hold positions forever. They bought at $40 to $50 and will sell at $80 to $90. There is no need to wait for 100. Now, a realistic forecast. The base scenario with probability 50% is that silver trades in a range of $65 to $85 for most of 2026. It periodically tests 90 to 95, but pulls back. By the end of the year, it is $75 to $80. It does not reach 100 because momentum weakens, profit-taking occurs, the economy slows but does not enter recession, and the Federal Reserve cuts rates but slowly. The bullish scenario with probability 30% is that silver breaks $100 in the second half of 2026. The catalyst is aggressive Federal Reserve rate cuts, supply disruption, or speculative mania. It reaches 110 to 130 by the end of the year. The bearish scenario with probability 20% is a recession or the Federal Reserve not cutting rates. Silver corrects to $50 to $60. Recovery takes 2027 to 2028. My personal assessment is that $100 is possible but not guaranteed. If I were forced to bet money, I would give a 40% probability that we see $100 at least for one day during 2026. More likely, the yearly high is 90 to 95 with a fast pullback. How to play this? If you believe in $100, do not buy everything at current levels. Scale in, buy in parts. If silver falls to 68 to 70, buy. If it falls to 60 to 65, buy more. If it falls to 50, load fully. Set profit targets. At $90, sell 30%. At $100, sell another 30%. At 110 to 120, sell the rest. Do not be greedy. Market history is full of people who held to the moon and lost everything on the pullback. Diversify. Silver should not be more than 10 to 20% of a portfolio at most. It is a volatile asset. Physical versus exchange-traded funds versus mining stocks? Combine them. Hold physical long-term, exchange-traded funds for liquidity, mining stocks for leverage but with risk. Watch the catalysts. Federal Reserve rate decisions, geopolitical events, supply and demand data from the Silver Institute, COMEX inventories. Technical analysis. Support levels at 70, 65, 60. Resistance at 80, 86, which is the old high, 90, and 100. And most importantly, be ready for volatility. Silver can fall 10% in one day and rise 15% the next. This is not for the faint of heart. Is $100 possible? Yes. Is it inevitable? No. Is it worth the risk? It depends on your risk tolerance. Good luck. 2026 will be an interesting year for silver, that is certain.